Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, and we're going to look at what Fannie Mae's updated guidance is for 2023 and more importantly 2024. Also, if you're thought about should I buy, should I sell, should I wait, I'm going to show you exactly what the data says. Everyone's situation is different, how to know where you fall at in that category. And if you're a real estate agent or mortgage person, what are transactions going to do? Are they going to go up? Are they going to go down? Being in the industry, we get paid on transactions, so we really would like transactions to go up, and they have fell really almost over 40% from where we were at when things were really crazy with super low rates. So really to understand kind of where we're going, we want to look at where we've been or what got us here. This is a chart of the 30-year interest rate, and you can see right here in January of really 2022, we were sitting at rates in the mid threes. Fast forward to September, we crossed over 6%. That is within an 8 or 9 month period, rates shot from 3 to over 6%. It really hadn't happened before that quickly or not any time in recent history. What did that do? That locked a lot of sellers in with homeowners with lots of equity and some of the lowest rates of all time. There was a lot of fear initially of another housing crash or something like that, and housing demand did fall, but prices really nationally just continued to rise. We did get some dips in some markets. When you look right here for median price, you can see, and this is nationally, it did dip down a little bit, but really since the beginning of the year, it's been on a freight train back up. And when we look at Fannie Mae's guidance, you're going to see a lot of it is just based on lack of inventory, and we're going to try to figure out if there's anywhere for that inventory to come from. At the time that I'm doing this, interest rates are at about 7%, really over 7%. So you can kind of get a guide there because really interest rates are going to really dictate what happened over the next couple years. I created this little slide to kind of give you a feel for the inventory or the supply side. So active inventory is down 40 to 50% from where we started when things were really booming right after COVID. Homeowner makeup right now, 38.7% have no mortgage at all, and 80% of the people that do have mortgages have rates below 5%. That is that lock-in effect, meaning right now we bottomed out. We were almost close to 7 million annualized transactions a year. Now we're closer to 4 million. So regardless of where anything's at, people will always need to buy and sell. And the bottom has been right around 4 million, which where we've been at for the last 3 or 4 months when you look at annualized sales. Now, when we look on the buyer side, buyer demand is down 40%, meaning less people want to buy when prices are high and rates are high as well. When we go over their guidance, one of the main points they're going to talk about, and you're going to see it reflected in the data, is extremely limited number of existing homes available for sale continues to define the future of today's housing market, according to the ESR Group, while total home sales remain near the lowest annual level since 2009. This is not due to lack of demand, rather than the ongoing lack of inventory, meaning regardless of how many people want to buy cars, if there's not a lot of cars to buy, sales are going to fall because there's just not enough supply to keep up with the demand. And when we look at Fannie Mae's housing forecast here, so housing starts, and I'll zoom in here a little bit, are expected, we were down 3%, we were down in 2023, 9.3%, in 2024, we're still predicted to be housing starts, meaning we can't really keep up with the current demand. One of the things to really think about is we have almost 2 million new family formations every year. Builders are building at about 1.4 million a year. That's not even keeping up with the current amount of demand that's coming online, much less all the pent-up demand of people that would like to buy in the right situation. When we look here at existing single-family home sales, so right now, this year, we're going to end up down 16.4%. But by 2024, we go positive. That means we've made up this negative 16.4%. So in 2022, we had about 5 million in annualized closings. Right now, we're about 4 million. It'll probably end fourth quarter in 2024, averaging right around 4 million annualized sales. But by the end of 2024, that's going to be up to almost 4.3 million, which means that really by every indication, the market is starting to improve. It's just going to be a slow trickle. The million-dollar question is, what's going to release the inventory? Because there is a lot of pent-up demand. If rates go down, I'm going to call that buyers on the margin. They're going to jump in as payments fall. But the inventory needs to keep up with the people that want to buy. And I'm always looking at how could that happen? How can we get a lot of sellers who have all this equity all of a sudden have a big incentive to want to sell? As a little thought experiment here, here's some data. So this is interest rates like I just showed you before, but this time I drew a line at 6% and I drew a line at 5%. Every time we have hit this 6% mark, and we did back in January of earlier this year, February and January, we've had a big spike in buyers jumping in the market. Right now we're back up to 7. So this 6, if we can break below this 6%, that really brings more and more demand or people that want to buy because payments are getting lower. This is a 5% line here, and I'm making this up, but there's starting to be a lot of pent-up supply. People that would like to sell, they need more bedrooms, they want a pool, they want all of these things. But rates have to get down. So at 7%, if you have a 3% rate, that could be almost $800 or $900 a month right there just for a lateral move. And then on top of that, you're probably going to up your price point to get what you want. So you've got these sellers that are just not going to sell, and they're really just figuring out how to hang on to their house and do improvements. But if rates fall to a certain point, and I'm going to say somewhere around 5%, I think some of that inventory gets released. And we really want, months of supply to be 3, 4, 5 months. That makes it more of a balanced market. And we've really had a hard time getting past 3 months. Right now we're under 2 months again. So really need to get rates low enough to release some of that supply. So interest rates obviously drive the market. I would say rates below 6% create demand in the market. MBA, the Mortgage Broker Association, is predicting rates to be 5% by 2024, and Fannie Mae is predicting rates to be 5.9% by 2025. Now, the actual numbers don't matter. The point is that rates are going to be going lower, prices are going to be going higher, and there's no one that can predict the market as far as some kind of black swan event. But in general, that's the way the market's moving. That's why Zillow and Redfin and all these entities are predicting modest appreciation and also predicting rates to get better. So the question is, should you buy, should you sell, or should you wait? So if you're a seller, the good news is the market is not going to change that drastically. So if you need to sell for whatever reason, whether it's this month, 3 months, or 6 months from now, there's not going to be any major price depreciation, at least in my opinion, based on the data. And so it's really just a matter of why you're selling, right? If you are going to sell and then become a buyer, well, then you have to evaluate your situation as a buyer. And for a buyer, it's a little bit different. So I mean, a buyer, if the answer is you're waiting because you're waiting for a price correction, then you're probably never going to be a homeowner. It's just not in the cards, at least what the data is showing. If you're waiting to qualify or to make sure you're in a better position, then that makes sense. And the market's not going to run away from you. We might get modest appreciation, but if you need to buy 3 months or 6 months or a year from now because that puts you in a better situation, then that really does make sense, because you're not going to have the market run away from you in a big way, but prices probably will be a little more expensive. And then if you're a seller that is going to become a move-up buyer, then you're in the best of all worlds, because you're going to have a lot of bigger down payment. You're going to be a conventional loan most likely, and even though more and more people are coming into the market, you're going to win out on those deals because you're going to be a stronger buyer, which goes back to if you're a first-time home buyer. One of the reasons we see first-time home buyers, even with the higher rates, starting to dip their toes and get into the market is because the ones that understand the math is that as rates fall, it's going to get more competitive, are trying to get in front of that, get a home as the market's a little softer, though it's still really a seller's market if you look at the supply. But get in front of that, buy now, and then refinance as rates fall, which is what is likely to happen going forward. So if you're waiting for a major price correction, I've had this conversation over the last 20 years many times. It's very hard to time the real estate market. You don't want to do that. You do want to put yourself in the best situation to be able to buy. And there's more programs that are available right now than I've ever seen in a long time. For instance, if you have a 630 credit score, you're almost getting the same rate as someone with a 740 credit score on a lot of first-time home buyer programs. There's hometown people. So there is a lot of incentives if you're a buyer to at least take a look. So that's what the data shows. Prices going up modestly over the next couple of years, rates starting to fall, and and really demand increasing about 15 to 20% each year going forward. And eventually, as rates get to a certain point, that'll release some inventory, and hopefully we'll get into a more balanced market. But for now, this is the new normal going forward, at least for as long as I can see for the next few years. We'll see. Could always be some black swan event. I hope not, but we never know what's going to happen. We'll keep looking at the data, and as more information becomes available in the market, as always, I'll cover it here. Have a great day. Have a great week. Let me know what I can do to help. Thanks.